An initial public offering, IPO, is the process by which a private company becomes a publicly traded company by issuing shares of its stock to the general public for the first time. Here are some key points about IPOs. 1. Going public. Before an IPO, a company is privately held, meaning its shares are typically owned by a small group of investors, founders, and employees. Going public allows the company to raise capital from a broader range of investors. 2. Regulatory approval. Companies planning an IPO must go through a regulatory approval process with the relevant securities exchange, example NYSE or NASDAQ, and regulatory bodies, example the US SEC. This process involves disclosing extensive financial and operational information. 3. Underwriting. To facilitate the IPO, the company typically works with investment banks or underwriters. They help determine the IPO price, create a prospectus for potential investors, and market the offering. 4. IPO price. The IPO price is the initial price at which shares are offered to the public. It's determined through a combination of financial analysis and market demand. The goal is to strike a balance between raising capital and providing a fair valuation. 5. Timing. The timing of an IPO can be influenced by market conditions and the company's readiness. Companies often choose to go public when they believe they can achieve the best possible valuation. 6. Share allocation. Shares in an IPO can be allocated to various types of investors, including institutional investors, like mutual funds, and retail investors. Allocation methods can vary and may include a lottery system for retail investors. 7. Lockup period. Insiders, including company executives and early investors, are typically subject to a lockup period after the IPO. During this time, they cannot sell their shares, which is intended to provide stability to the stock price. 8. Trading debut. On the day of the IPO, the company's shares start trading on the stock exchange. The first trade is known as the opening trade, and the stock's price can fluctuate significantly in the early days of trading. 9. Volatility. IPOs are often characterized by price volatility in the initial days or weeks of trading. This can be driven by speculative trading, investor sentiment, and the company's performance. 10. Long-term considerations. Investors should carefully evaluate an IPO investment based on the company's fundamentals, business model, and growth prospects. Consider both short-term price fluctuations and long-term potential. IPOs can present investment opportunities, but they also carry risks. It's essential for investors to conduct thorough research, understand the company's financials, and assess the IPO's potential for long-term success. Additionally, IPOs may not always be available to retail investors, as some are reserved primarily for institutional investors or high-net-worth individuals.